So I think it's finally time we address the elephant in the room that is Trading 212 and whether your hard-earned money is safe. I'm sure everybody knows by now, but Trading 212 is a commission-free investing brokerage, which is amazing because it's encouraged so many people to get involved in investing to try and grow their wealth. Historically, investing has always been seen as something only for the rich, with high trading fees and sometimes high share prices acting as barriers to entry for the individual with small amounts of cash. Then along comes Trading 212, offering zero commission trading and fractional shares, allowing somebody to invest with as little as £1. But in that detail lies the downfall of the company, or at least that's what people are beginning to believe. If Trading 212 are not making money through commissions, then how are they able to sustain the business, and what does that mean for the billions of pounds that is currently invested in the platform? You only have to scroll through YouTube to see the abundance of videos discussing whether Trading 212 is safe, and here I am adding to that collection. Anyway, there are really two key points to address here, with the first being how do they make their money. Well, Trading 212's entire business model is to lure people in with their commission-free investing, running that segment of the business at a loss in the hope that people will pivot from the investing platform onto the significantly more risky CFD trading platform where they do charge commissions and thus make their money. Now, I won't go into the details of CFDs in this video, but in short, it stands for Contract for Difference, and the objective is to predict relatively short-term price fluctuations in a particular security, often using leverage. 76% of people that trade CFDs lose money long-term, so the solution to that for the vast majority of people is simple: just don't pivot from investing to CFDs. So that is how Trading 212 makes their money. So everything is fine, right? Well, no. In 2019, the company's revenues fell by 47% due to increased regulation on the use of leverage, and as a result, the company reported a loss of £315,000 compared with a profit of £1.5 million the year before. But you might be saying, Hakeem, that was 2019, and given the number of people that began investing in 2020, I'm sure they're now profitable. And you might be right, but we don't know because they still haven't released their annual results for FY20. Now, the deadline for private companies required to publish their accounts is usually 9 months after the balance sheet date, but an extension to 12 months has been granted due to the pandemic, so it's likely that we'll have to wait just a little bit longer. But it's not just the financial performance of the business that has users of the platform concerned. Back in January 2021, there was a surge in people signing up to invest following the GameStop saga, and rather than capitalise on the increased demand, the company suspended new sign-ups with no real explanation and still has not fully reversed the suspension 9 months later. Shortly after this, the company announced that the CEO would be leaving, and this led to speculation and conspiracies that he was simply jumping from a sinking ship. After that, the company went against its fee-free trading by introducing foreign exchange fees for trading overseas stocks. So it's all of these factors which has users of the broker concerned about whether they're going to continue to exist and what happens to the money and stocks they have within the account should the worst happen to the company. But I'm here to tell you that all of that doesn't really matter for the vast majority of people. Firstly, Trading 212 are regulated by the Financial Conduct Authority, meaning they have to comply with strict regulations and act in the best interests of its users. Secondly, all client funds are segregated in separate bank accounts and are covered by the Financial Services Compensation Scheme, meaning your cash and assets are protected up to the value of £85,000. So you might be saying, okay, fine, but what about those fortunate enough to have assets in excess of £85,000? This is where I often see incorrect advice or statements being made. Well, as long as the assets are in the form of stocks and not cash, you will almost certainly be fine in the event of liquidation of the broker. When you make an investment, Trading 212 holds the underlying asset in a nominee account to which you are the beneficial owner and which they are not allowed under any circumstances to dip into. So in the event of liquidation, the shares that you had in your account don't just disappear. They will need to be transferred to another broker, which usually comes with charges, but again, the FSCS protection will usually cover that. There was actually a case similar to this back in 2018, where a stockbroking firm called Beaufort Securities collapsed, and the administrators, PwC, wanted to use some of the assets held by the firm on behalf of their clients to cover their fees. Long story short, the regulators blocked that action, stating that the clients' assets were ring-fenced and the investments were transferred. The downside is that it could be a lengthy process, meaning you'd be unable to trade the shares and receive dividends during that process, but you should eventually receive everything that is due to you. The only realistic and feasible scenario where your investments would not be safe would be a case where management act unlawfully and fraudulently and dip into client assets either for themselves or for the business, meaning that investments plus cash greater than £85,000 could be stolen. But FCA registration requires controls and procedures in place to reduce the risk of this as far as possible. So despite all of the fear-mongering that exists on YouTube and other platforms about Trading 212, your investments are well protected. A realistic worst case scenario is that there's a period of time where you can't trade or receive dividends whilst your holdings are transferred to another broker in the event of the company going into administration. On top of that, make sure that you don't hold more than £85,000 of cash in your trading account, because any amount above that won't be protected by the Financial Services Compensation Scheme. But that rule applies to all financial institutions, not just Trading 212. So there we have it. You can continue to use Trading 212 without the fear that you're going to lose all your money, unless of course you're YOLOing into penny stocks, in which case, good luck to you.